Washington, D.C., Tuesday morning. Jensen Huang walks on stage in his signature black leather jacket. He tells the crowd something that has never been said in the history of capitalism. His company, Nvidia, just secured $500 billion in orders for AI chips through the end of next year. The next day, Nvidia crosses $5 trillion in market cap, the first company ever to do it, bigger than Microsoft, bigger than Apple, bigger than the entire French stock market. And on the exact same week, on the other side of the city, the Department of Justice quietly ships another round of civil investigative demands. Target Nvidia. Subject monopoly practices. $5 trillion on one side, a federal antitrust probe on the other. And almost everyone watching thinks the story here is the AI bubble around OpenAI, around Anthropic, around the chatbot arms race. It is not. Because the companies everyone points to as the bubble, the model labs, the agent startups, the vertical AI apps, those are the tip of the pyramid. The base sits one layer down, one company, one chip, one software stack called CUDA. And that base today is more concentrated, more financially exposed, and more legally vulnerable than anything floating above it. The real fragility is not in the models. It is in the picks and shovels. It is in one company selling one type of chip to 6 customers, burning somebody else's money to buy them. And when we pull the thread, what looks like the most powerful machine in financial history starts to look a lot more like a house of mirrors. Welcome. Let's break down the $5 trillion trap. To understand why Nvidia at $5 trillion is a problem, we need to understand how Nvidia got to $5 trillion in the first place. Jensen Huang co-founded the company in 1993 at a Denny's in East San Jose. 3 guys, $600 of initial capital, a business plan written on napkins. For 20 years, Nvidia was a niche name. It made graphics cards for video games. Nerds loved it. Wall Street barely noticed. Then, quietly, something interesting happened. In 2006, Nvidia released a software platform called CUDA. It let programmers use graphics chips to run calculations unrelated to graphics. Scientists started using CUDA to run physics simulations. Banks used it to price derivatives. And one small group of researchers used it to train a new kind of neural network. That group included a handful of names now famous in AI. When those neural networks started beating every benchmark in computer vision, nobody asked why. The answer sat quietly inside every lab. They ran on Nvidia GPUs through CUDA. For the next decade, nobody cared. AI was academic. Nvidia's revenue came from gamers. Then, November 2022 happened. ChatGPT launched. In 2 months, it hit 100 million users. Every technology company on Earth suddenly needed GPUs. Not a few thousand, millions. Nvidia was the only seller. The math from there is almost cartoonish. $1 trillion market cap in June 2023, $2 trillion by February 2024, $3 trillion in June 2024, $4 trillion in July 2025, $5 trillion in October 2025. The doubling time collapsed from 8 months to 4 months to 3. In 28 months, Nvidia added $4 trillion of market value. That is more than the combined market cap of every listed company in Germany. More than the GDP of Japan, added to a single stock. Put another way, for every dollar the S&P 500 gained in 2024, roughly 1/3 came from Nvidia alone. An index fund with $1,000 inside it now has more exposure to this single company than to every European bank combined. Passive money, pension funds, sovereign wealth, 401ks, quietly became the largest Nvidia shareholder on Earth without anybody ever pressing buy. The story Wall Street told itself was simple. AI is the next internet. Nvidia is the one selling the compute. Therefore, Nvidia is Cisco in 1998, right at the beginning of the curve. The problem with that story is that Cisco is also Cisco in 2001, down 90%, still not back to its peak 25 years later. Here is what nobody puts on the cover of the Wall Street Journal. Nvidia has a customer concentration problem that would get a private company laughed out of a Series A pitch. Look at the last 10Q filing. Fiscal third quarter ending October 26th. Total revenue, $57 billion in 90 days. 4 customers, labeled A, B, C, D, account for 61% of that. Customer A alone, 22%. Customer B, 15%. Earlier quarters showed 2 mystery customers together eating 39% of total revenue. Nvidia does not name them. Analysts agree on the likely identities: Microsoft, Amazon, Google, Meta, possibly Oracle, plus a handful of contract manufacturers assembling servers for those same hyperscalers. 6 companies, $5 trillion of market cap. For comparison, Apple at its peak had a top customer concentration in the single digits. Microsoft, same. Even Tesla, at its most distorted, had customer risk spread across hundreds of thousands of individual buyers. Nvidia has the concentration profile of a niche defense contractor, priced like the entire internet. Now the second layer. Those 6 customers are not generating cash with their Nvidia chips, not yet. They are building out data centers for AI workloads that, for the most part, run at a loss. OpenAI is the test case everyone points to. Revenue in 2025, roughly $13 billion, tripled year over year. Cash burn in 2025, around $9 billion. Projected cash burn in 2026, $25 billion. The company expects to lose money every year through 2028, with operating losses peaking somewhere around $74 billion in a single year before, according to internal documents, miraculously becoming profitable in 2030. OpenAI alone has already revised its total cash burn projection upward by over $100 billion through 2030. This is the customer buying Nvidia's chips, not a profitable hyperscaler using GPUs to run ads. An AI lab burning through cash at a historic pace, funded by investors on the bet that eventually, somehow, the math turns. Here is where the story gets genuinely strange. In September 2025, Nvidia announced a $100 billion investment commitment into OpenAI. The structure is what analysts started calling circular. Nvidia puts equity into OpenAI. OpenAI uses that money to buy or lease Nvidia chips. New Street Research ran the numbers and estimated that for every $10 billion Nvidia invests in OpenAI, it sees about $35 billion in GPU revenue come back. The same pattern shows up with CoreWeave. Nvidia owns about 7% of CoreWeave. CoreWeave has bought something like 250,000 Nvidia GPUs, worth $7.5 billion. Nvidia separately signed a $6.3 billion deal to buy unused CoreWeave capacity. Circles within circles. In the late 1990s, Cisco ran a version of this play. It extended vendor financing to telecom customers so they could buy Cisco routers. When the customers went bankrupt, so did the revenue. Cisco stock fell 89%. Bernstein analyst Stacy Raskin put it plainly when the Nvidia OpenAI deal broke. The action will clearly fuel circular concerns. The mechanics also help explain how every AI startup in the valley suddenly borrows at single-digit interest rates. Nvidia's equity stake acts as an implicit guarantee. Lenders see the green logo on the cap table and drop their spreads by 5, 6, 7 points. That is billions of dollars of cheap capital that would not exist if Nvidia was just a silent supplier. And every one of those dollars eventually circles back as a chip order. Then there is the regulatory layer. This is where the DOJ shows up. The Department of Justice opened its Nvidia antitrust probe in 2024 and kept widening it through 2025 and into 2026. Civil investigative demands went to Nvidia directly. Competitors, including AMD and Intel, were contacted for complaints. 3 core allegations. First, tying. Pressuring cloud providers to buy Nvidia GPUs bundled with Mellanox networking gear, with better pricing for those who accepted the bundle. This is almost a textbook description of what Microsoft was accused of in 1998 with Internet Explorer and Windows, except the dollars involved are bigger and the market share is higher. Second, exclusionary conduct. Allegedly threatening to delay chip allocation for customers who also bought from AMD, Intel, or startups. In a market where waiting 4 quarters for a shipment can cost a cloud provider tens of billions, that threat has teeth. Third, the software moat. CUDA is the real weapon. Every serious AI model in the world today was trained with tools that run on CUDA. Porting a codebase to AMD's ROCm or to Google's TPU stack can take months. French regulators have already named CUDA specifically in their probe. US investigators are reportedly studying whether Nvidia has technically blocked competitors from interfacing with it. And a final pressure point nobody likes to say out loud. China's State Administration for Market Regulation preliminarily ruled in late 2025 that Nvidia violated its antitrust commitments on the Mellanox acquisition. Chinese regulators found Nvidia had failed to uphold fair, non-discriminatory supply terms. One monopoly finding in China, one widening investigation in Washington, one antitrust review in France. At the exact moment the company crosses $5 trillion. For 20 years, regulators move slowly against dominant platforms, and then they move all at once. The Microsoft case filed in 1998 was shaped by complaints from rivals the DOJ first talked to in 1994. 4 years of quiet information gathering, then the hammer. Nvidia's timeline is already deep into that information gathering phase. Subpoenas issued, rivals interviewed, cross-border coordination in motion. The question stops being whether a case comes and becomes what the remedy looks like. So the asymmetric risk is real. The question is which domino falls first. Scenario 1. The models underperform. DeepSeek already showed the playbook. January 27, 2025. A Chinese startup nobody had heard of released an open-source AI model that matched OpenAI's performance. Training cost, reportedly, $5.6 million. For comparison, OpenAI's GPT-4 cost over $100 million. The market reaction was the largest single-day wipeout in history. Nvidia lost $589 billion of market cap in one session, down 17%. That is the entire market cap of Bank of America, gone, in 6 hours. Because one research paper suggested you might need fewer GPUs than everyone assumed. The stock recovered, but the structural question never went away. If efficiency breakthroughs keep coming, if the big models get 10 times cheaper to train, the demand curve that justifies $5 trillion quietly bends. Scenario 2. Hyperscaler CapEx cuts. The Big Five, Microsoft, Google, Meta, Amazon, Oracle, are projected to spend $602 billion on infrastructure in 2026. Roughly 75% of that goes to AI. Those companies raised $108 billion in new debt just in 2025 to fund the build-out. Projections suggest up to $1.5 trillion in total debt issuance for the AI cycle. Those numbers are only sustainable if two things stay true. First, the models keep getting more useful at a pace investors accept. Second, interest rates on that debt stay manageable. Shake either assumption and suddenly a CFO at Meta or Google is presenting a 20% CapEx cut at the next board meeting. That is not a small adjustment. Nvidia's guidance depends on those checks arriving, quarter after quarter, for years. Scenario 3. The DOJ wins. The Microsoft case from 1998 is instructive. Microsoft was found liable. The company was not broken up, but the behavioral remedies constrained how it bundled products. More importantly, the legal cloud gave rivals space to exist. Firefox happened, Google happened, Chrome happened. The monopoly did not collapse overnight, but the extraction power was capped. If the DOJ ever forces Nvidia to unbundle CUDA, to license interface specs, to stop preferential allocation, the 90% market share will not stay at 90%. Even dropping to 60% with margin compression would rip trillions off the valuation. Scenario 4. The competition finally wins back share. AMD's MI350 ships mid-2025 with 288 gigabytes of high-bandwidth memory. The MI400 series, due early 2026, pushes that to 432 gigabytes and 19 terabytes per second of memory bandwidth. Microsoft, Meta, and OpenAI all signed deployment commitments. Grok sells dedicated inference chips that are an order of magnitude faster per dollar on specific workloads. Google's TPUs run a meaningful portion of its own AI workloads already. None of these alternatives dethrone Nvidia tomorrow, but each one at the margin chips away at the pricing power. And pricing power is the entire story. Nvidia currently runs operating margins above 60% on its data center business. The valuation assumes those margins hold. History, in every other semiconductor cycle, says they don't. Aswath Damodaran is the professor known as the Dean of Valuation. He spent 4 years building a position in Nvidia. By the end of 2025, he sold the entire stake. He said the AI industry would collectively need to generate $2, $3, maybe $4 trillion in revenue eventually to justify the capital currently committed to LLMs. His warning was direct. Investors going into that space risk being eaten alive. He still owns Microsoft. The distinction matters. A diversified cloud business with thousands of enterprise customers, each paying a subscription, has a floor. A specialist chip business dependent on 4 buyers running at a loss does not. That is the risk asymmetry in one sentence. Jensen Huang now owns about 3.6% of Nvidia. At a $5 trillion market cap, that single position is worth somewhere in the range of $170 billion. He is the 7th richest person in the world. His fortune has roughly doubled in 18 months. His entire net worth, minus the early Denny's capital, sits inside one stock. One stock with 6 customers. One stock selling to AI labs burning somebody else's money. One stock with a federal probe widening. One stock priced for a future where compute demand compounds forever. The counter-argument exists, and it has to be said. Blackwell is shipping. Rubin is ahead of schedule. The roadmap through 2027 is real. The architecture is genuinely superior. There is no viable alternative at scale today. The engineers at Nvidia are not slowing down, and the software moat is not evaporating next quarter. But the question on the table is not whether Nvidia is a great company. It is. The question is whether a great company with 3 codependent customers, buying with borrowed money, selling to an AI sector that loses $100 billion a year, and sitting inside an active antitrust probe, is worth $5 trillion. If the answer is yes, a lot of things have to go right for a very long time. If the answer is no, it does not matter how good the GPU is. The first crack will not come from a competitor. It will come from one customer cutting CapEx by 15% on a Tuesday earnings call. It will come from one DOJ filing. It will come from one efficiency paper out of a Chinese university. And every index fund holding Nvidia at its current weight will feel it. There is a small detail worth remembering. In 1999, Cisco was the most valuable company in the world. By every metric that mattered, it was going to own the internet. The router market share was over 70%. The software ecosystem was unmatched. Every hyperscaler of the era was a customer. Today, Cisco is worth less than 1/10 of what it was worth then, even in nominal dollars. The internet still happened. The picks and shovels bet still lost. That is not a prediction. It is a reference point. Watch the next hyperscaler earnings call. Watch the DOJ docket. Watch which customer Nvidia declines to name in its next 10Q. The bubble isn't the models.